This is For Advisors by Advisors. I'm your host, Evan J. Mayer, and today we have a very special guest, Mr. Shane Morrow. How you doing, Shane?
Excellent. Thanks for having me. I'm excited to be back in Florida.
Well, welcome to Florida.
Yeah, it's a great time of year here.
I was just in Austin. I was at a conference, and it was in Austin. And normally I don't go to a lot of these conferences, but I'm like, if it's ever a city I really want to go to, worst case scenario, I'll go and skip the
have
sessions.
some good food.
Yeah, and we went to Terry Black's. And it was absolutely phenomenal. I went twice.
Well, it's you got to go for breakfast tacos, and then you get dinner too.
Yeah, they have breakfast tacos in the morning there? Not there. They open at like 11. Yeah,
everywhere's got breakfast tacos. Yeah, Austin's known for barbecue and breakfast tacos.
So I went to a taco place that was down the street from the hotel. I think we were at the Marriott.
JW there?
Yeah.
That's the center of business section right there.
Yeah, it was good. It's great city. We'll talk about that in a moment. Shane is the director and managing partner and CEO of IronBridge Wealth Counsel. By the way, Wealth Counsel.
Yes.
Not wealth, not the Wealth Counsel, I guess.
Wealth Counsel
is you guys.
And the wealth, like you said, planning, partner, strategic, fill in the blank. There's a million of them. Counsel was advice, right? And spelled like law counsel. So the idea was we're not in the business. We're in the business of giving advice. So we want to be perceived, and everything from how we run our practice to actually the naming of it should construe that we're in the advice business.
Very cool. Very neat and niche in the concept that other people are not doing it. So, and it looks like there's 6 partners in the practice and maybe
about 5 partners. Yeah.
And then 10 advisors and about 12 support staff.
We have, we've grown the last couple of months. So it's about 14 total. One is still yet to be on the website. So that's probably why.
Got it.
And then we have 15 staff support between technical support, CFAs, CFPs, and then administrative and operational support.
And you guys are duly registered. You're your own RIA, and then you decided to connect with Sage Point.
Yeah, we did. So, it was extensive review to see who the best partner from a business standpoint. And then we had to make a decision. Do you go full RIA? Do you do a hybrid? Do you not have an outside RIA? So we landed on the hybrid. There's some internal business decisions why that came about. Gives some flexibility. And we had one individual who was joining us who had a 66 only. So it allowed us to have that flexibility to have that person just.
So were there some broker dealers that could have affiliated with, but because that person didn't have their 7, it was an issue.
Yeah. And there's some other things like setting up solicitor fees. Some places do, some don't. So it gave us an outlet to do things that is completely blessed by the home office on that side, but they don't have to make a decision for firm wide. That we can do it and then make sure we're handling all the compliance aspects.
So let's do this because I want to hop into that a little bit, but I do want to give you a quick introduction. So Shane's been licensed since 2004, been in the business almost 20 years. And tell us a little bit about your history in business. How did you get into business? What did you do for the first 12 years before you started IronBridge?
Sure.
And then kind of what's gone on at IronBridge since 16?
Yeah. So going back to square one, father was a DE agent, right? So I'd never had finance on the landscape. I wasn't the person that said, I always want to work on Wall Street, or my dad ran a practice or anything like that. I thought I was going to go to the CIA in college, and turns out it was not a good time given my lack of credentials to do that. So I was an economics major at Amherst College, and my dad said, you're smart enough, you probably should do something other than the bureaucracy of a government. So went to work at a Tampa high-end custom third-party asset management platform here in Boca Raton. In 2004, spent about 9 years there, working my way up from an analyst all the way to, I was a director of investment consulting, basically in charge of, we had about $2 billion of AUM at the time. All firm-wide asset allocation decisions, was traveling a lot, and our clients were high-end advisors. The independent broker-dealers, the insurance broker-dealers, they looked to us for their $1 million clients and higher. It was all custom, separately managed accounts and things like that. Yep, SMAs. So that's where I cut my teeth for the first 9 years. Got my CFP, SEMA, wind up getting my KIA later, and did level 1 CFA, and my wife's a CFA. So one in the house after trying to study for level 2. I've accepted that one in the house was probably enough.
Where's your wife work?
She worked for, Thomson Reuters. She was an analyst for a long short strategy. And then when we moved to New York after Florida, she was working for Thomson Reuters, which became Refinitiv, which became London Stock Exchange Group. And then we had a son, and we had the decision of where do we want to go? We've grown significantly. We need analysts, and it gave us a lot of flexibility. So she's on our team now.
That's awesome.
Yeah. So we work well, and she's the equity person. I'm more of a fixed income background. So we know our lanes and we do pretty well with that.
Excellent.
Yeah.
When did IronBridge come to be your partners? Were you partners prior to IronBridge?
Yeah. So most of them I'd worked with for 15 plus years. Most of them were our clients in essence when I was at the asset management firm. After that, I took a job in New York City for New York Life, helping them roll out InvestNet. So I got to see from the corporate side how the sausage is made, the technology platforms and all that fun stuff. And I was there long enough to realize, as my wife said, if I don't do something on my own, I'm not going to be happy. And I'm just not a very good corporate employee at the end of the day. So I had that entrepreneurial bug.
I understand.
Yeah, exactly. Most advisors do. Yeah. The entrepreneur bug, but it's a scary jump, right? For anyone going from a pretty good paying corporate position with some security and stability to zero. So I took a circuitous route. Then I took a job as a institutional client PM for a fixed income firm in Austin, Texas. Wanted to get out of New York. 2 years in the city was awesome, but that was plenty for us and my dogs, and wanted to see the stars and not have to deal with winters and fun stuff. And then that bug was still there. So long story short is you have the path, right? Do you go out and start your own RA? Easy enough to do it in this day and age, right? There's consulting firms and that will set it up for you and file, and places like XY Planning and all that stuff to help you kind of get launched. Or do I go to a firm that I had relationships with that provide the flexibility to kind of build more of an ensemble structure, which was always my desire.
And what were you personally managing at the time? How many clients in AUM?
When I left,
Yep.
started at zero.
Got it.
Literally.
Got it.
So the decision would you start at zero and go to your best potential clients, say, hey, give me your life savings. I just got started. We have no assets under management. I've engaged this compliance firm, but I'm wearing all these hats. So the decision was go back to the firm that I worked well, that I thought had some of the best financial planners, that I had really good relationships with them. They knew me, they trusted me, and they also knew that I knew how to run the investment side. So I, in essence, built the practice from scratch with the idea that I could come in, add a creative value to their practices. And because of cost savings with outside TAMPs that we could aggregate on a central InvestNet system, to them, their revenue would almost be net neutral. So I affiliated at Lincoln with the idea that they were very flexible. I knew some of the key management, which were very supportive of someone starting at zero, which is usually not the case. So I was very appreciative for that. So I was an advisor there, just like them.
Oh, you were?
Yeah.
So you did come over as an advisor.
Yeah. So if you think about, I was an advisor, but instead of bringing, I had my own direct clients, but I went to them and said, Tom, Jane, let me run the investments for you. And for some of your clients that I know really well, we'll consolidate it. You have assets on 3 different TAMPs. That's inefficient. Let's run it as a more institutional business structure.
Yep.
And that's how we kind of went from zero to initial beta stage in essence, and scaled from, 1 advisor to 2 advisors. And now, as you mentioned, we're 31 people. But that took a kind of a journey. Part of it was I had a trusted relationship with them prior.
Yeah, to come in and for the investment management process. Right. So you actually didn't come in as a financial advisor with a book. You came in to handle the investment management for these 5 or 6 advisors.
Correct. And then it allowed me to build my individual book more thoughtfully, as opposed to, hey, how many people do you know that has a rollover IRA to be able to pay your mortgage?
And now in 2022, what's the AUM of your firm?
Just shy of $1 billion.
Awesome.
Yeah.
Awesome.
Yeah.
So you were with Lincoln for a long time, and we talked about this for a quick second pre-call, decided, hey, time to look elsewhere. Talk about that decision. What guided that decision, and what were your thoughts as you were
it was a difficult one, because Lincoln was a great home. I think they have some of the best planners that they've come across. Great culture. Structurally, the way we were set up, we are more of a national ensemble. I live in Austin, Texas. I would partner in Florida, New Mexico, Phoenix, Connecticut, Illinois. So we're a little bit of a different animal in terms of that business model. Yeah. And our growth was a little bit non-traditional in the sense we were building a bigger and bigger ensemble structure. So I would just say we realized that we probably needed different corporate partners to continue if we wanted to 10 times the size of the practice, which is our kind of internal goals. We needed to kind of look outside. It was a long diligence process, for everyone from LPL to the Ray J's to the Commonwealth to the advisor groups. And it came to where we want to be, where we are today. This is a great fit. Where we want to be in 5-10 years. What do we need to be doing today, and building those infrastructures and those processes and having those corporate partners that are willing to support a hybrid structure.
And how did Sage show you what they could do compared to where you were?
Yeah. So SagePoint's a part of the advisor group. They now have, I believe, 8 broker dealers. They just keep buying, but they have 8 broker dealers. And when we looked at it, we want to keep things as similar as possible. Same custodian, same investment platform, same CRM system, same financial planning software. So that narrowed the field down pretty significantly. We wanted someone that was going to be a good corporate partner, understood our value proposition and also where we wanted to go, was willing to support that. So again, that narrows down some of the field pretty significantly.
Yeah.
And then it comes down to personalities. You want to do business with people that you like, and you feel that they can trust you and you can trust them to, when you hit roadblocks, which everyone does, right? There is nothing perfect out there. That you at least are willing to work through them and understand there's certain business decisions that a home office or corporate partners have to make that you may not 100% agree with, but at least there can be a business decision that's talked through.
This was just in May you went over.
That was,
right?
yeah. It was early May that we left and changed our back office or affiliation.
Now, I also saw that Fidelity is the custodian listed. Most corporate RIAs that I see do use more than one. Yeah. Was that a specific choice you've done that? Are you looking to build upon that in the future? What are your thoughts there?
Pershing's also an option. We've used NFS and Fidelity for all of our clients. It seems like from a scalability standpoint, if we're really truly building as a systematized and institutionalized ensemble practice, we need to have similar investment process, similar financial planning process, similar technology, similar systems, because if I get hit by a bus, my partner takes over the business, we need to make sure we're running as a seamless entity. And from that standpoint, having multiple custodians, there is some flexibility, I'm sure. For us, it creates some complexity with our staff and operations.
For trading and
trading, reporting, and paperwork systems and things of that nature. So we're not necessarily saying that's never going to happen. It's just today, as we stand, we haven't seen a distinct reason to do that.
Reason to go somewhere else. On top of being CEO and obviously trying to grow the firm, you're the head of the investment management division for your firm.
For the time being.
Well, let me ask you a question on that. Your advisors that you bring aboard, are they part of that investment committee when they come in, if they want to be? And do they have to use your same investment prowess, or can they kind of do whatever they want to do themselves?
Yeah. So, we're pretty open architecture. And at the end of the day, we don't have a monopoly on good ideas, right? There's a lot of smart people out there.
Yeah.
We run our own models. If you look at our aggregate AUM, about half of it is rep as PM. 25 to 30% is fund strategists, and the balance in SMAs. Obviously overlaying that, you have UMA functionality and things like that. But if you look at the 3 different programs, that's about the breakdown. We run our own models. We build from, globally diversified models, from active passive only. We have target specific strategies like cash management strategy, alts, multi-asset income. We also run 2 individual equity portfolios internally. With that being said, no one has to use any of them. So we put them there for advisors that join us. They have access to all the models they can implement on their own. They get the benefit of the rebalancing, the research, and the analysis that goes into it, but they can build their own.
And those are
so choose.
Those are all individual equity. The 2 models are individual equity models.
We run
then you probably run an ETF model for smaller accounts, things along those lines.
Like the global series is a ETF fund model, which is globally diversified, like a fund strategist portfolio.
Got it.
Yep.
Talk to me on the fixed income side. What are you guys doing on that side?
Yeah. So for a lot of individual bonds, we'll use separately managed accounts, SMAs.
Use SMAs for it.
We do. We run, obviously part of the models, we have bond allocations, whether it's ETFs or mutual funds. But for true customization or building liability streams, I came from an institutional fixed income shop. I know that I'm not a good bond trader, and I'm not going out there trying to portray that we're doing bond trading internally. So a lot of, if it is for larger institutional or high net worth accounts where we're looking at individual bond usage, a lot of times.
So you are doing that for if the net worth is appropriate.
Yeah. And if there's a specific need, non-IRA assets, things like that.
Talk a little bit about alternatives to structured investments specifically. Are you guys in structured investments? Are you doing that for clients?
We've used systematically structured annuities, RILAs, right?
The structured annuities.
Yeah. Where we've looked at those as more alternative investments. Most of them looking at 6-year investments. Obviously, there's trade-offs between upside with the benefit of some downside protection. And if you look at, I think some of the analysis I've seen from the empirical standpoint, you're really trying to get more of a risk return characteristic of an alternative investment, right? You have some illiquidity because there's lock-ins. You have downside protection. You have some giving up of some upside to accomplish that. And you have a diversifier. So we've used structured annuities in that capacity as more of an alternative. We have some non-traded REITs. We have One of our managed portfolios is a liquid alt, so 40 Act fund and ETFs and things like that.
Yeah.
And obviously you can only get so much true illiquidity premium from that. But, there's some interval funds and things of that nature. And now we do have access to, and I think it's in the pilot, but we have access through Case to LPs and things of that nature on the alternative side.
Got it. Talk a little bit about recruitment. Advisors are,
yes.
I'm seeing an entrepreneurial mindset. And what's interesting, and I've learned this more on the podcast because I'm in my 40s. And so the younger generation, I'm not quite understanding the mantra of work, but most of them, and it's funny, we have a 25-year-old that works for us here, and she goes, I don't understand my group either, but I will say they're all trying to get rich right away, and they're all trying to have full independence doing it. So I'm wondering, are you seeing an influx of younger advisors getting into the business, specifically on the RIA side? And when we are talking about older advisors that are already in the wirehouses, that recruitment situation is probably completely different than the younger generation.
Yeah. And we've kind of realized our target advisor is that under 50 that's looking to, they've gotten to a place where they're really comfortable, but they realize that there's more to be done and they need a team and resources to scale.
Yep.
That's where we find that's our best fit. And beyond that, they want culture. They want to be a part of something. They want to be part of a mission to create a multi-generational firm that puts their clients, their colleagues, and their communities first. So we have a community foundation that we created. So I think culture is a big trigger word.
Yep.
And it's an overused word because a lot of times people say, oh, it's all about culture, but it becomes watered down at some point. I think that's a big component of our recruitment is finding the right person that fits that culture and realizing that's not going to be a lot of people and being okay with that, right? Knowing what you shouldn't do is almost important what you should do. So where we found some success from a recruiting standpoint is people that have known us, people that are true financial planners that want to almost lead every client meeting with a separately charged financial planning fee, that want to do really great planning work and also be a part of a culture that looks at us as a true ensemble and not just siloed advisors that are doing their own thing and happen to have the same DBA name.
And regarding financial planning and charging for that planning, what percentage of IronBridge's revenue is from charging for plans?
I would say 15 to 20%.
Okay, that's pretty high. Yeah.
Almost all of our clients have some type of planning fee, whether it's obviously the ultra high net worth or even the younger generation, where we found a lot of success with retainer type models, planning fees, where instead of charging someone $10,000 a year, one time every 3 years, you charge someone $300 a month, and you're doing really good planning because they're in their own personal development stage, their professional development. And there's things that come up from kids and new employment and estate planning, and those things can take time to work through and are constantly evolving.
And for those advisors that might be charging based on AUM and including that in the mix, you're not siloing those advisors. They can absolutely do it that way as well.
There's a lot of different ways. Yeah. There's a lot of egos in this industry, right? And I think there's a lot of people that think that they've figured it all out. We haven't. There's a lot of good ways. There's no one perfect way. There's a lot of wrong ways.
Yeah.
I think the challenge that people have, and I would just encourage, is if you're going to do it that way, just make sure you're actually doing the planning. What we find is if you don't charge for it, people don't value it, and you rely on focusing on what you're actually getting paid for, which is usually assets under management, and not doing some of those other things as much justice as they should have.
Yeah, absolutely. Talk a little bit about the difference between good advisors and bad advisors. You've been around many. What stands out to you in the difference between a very good advisor and an advisor that's bad? But personality-wise, you can meet both of them at the bar and like them both the same, and their personality is almost the same. But what drives the good advisor to be good and the bad advisor to be bad?
That's a loaded question, right? I mean,
that's the goal.
Yeah, I mean, that's coming from a law enforcement family, right? My dad said there's 3 people you need to be worried about in life, right? And he bought heroin from people in Detroit and Cincinnati and
undercover, of course.
Yeah, exactly. Flew in Blackhawks looking for Pablo's planes and stuff when we lived in the Bahamas. He said there's 3 people: lawyers, doctors, and financial people. Because he said anyone that can screw with your health, your wealth, or your freedom, you got to watch. And the challenge I have with this industry is there's so many people masquerading as financial advisors that are really product driven. So I think what I think are bad advisors are people that don't clearly define who they are and what they do to the end client, because the lay person doesn't know the difference between a CFP, CPA who, does flat fee billing and is paid based on their advice, and someone who has a 6, drives a really nice car, goes to all the right social events, and is looking like a financial advisor. And those 2 things are very different. I wish our industry did a better job of separating the dentist and the dental hygienist. and they both have a role, and it's not derogatory or trying to take away from either side, but the end client doesn't know the difference. So I think good advisors are the ones that clearly delineate who their ideal clients are, how they work best with those clients, and don't try to over deliver in the sense, if I don't have an expertise for a certain type of client or a certain type of service, I shouldn't be charging or trying to do it and masquerading as having an expertise there. And that's where I would say bad advisors are trying to say they can work with anyone. I can work with multi-generational family business planning, ultra high net worth, sports, private practice doctors. And what you have is someone that does a really poor job probably of all of it. And I think that's where how we look at delineating good versus bad is making sure the end person knows that you are the best fit for what they need. And if that's an insurance sale and you're a great insurance person, great. I'm not saying that trying to be derogatory to any one person, because I think there is.
No, I fully agree with you. 100% agree with you. And there are people that are masquerading as financial planners, but they're insurance salespeople that are looking for the next insurance sale, or they're managed money people that are putting you just in investments. And there are CFPs, and not every CFP is created equal. No. There are people that have the CFP designation that literally don't do any financial planning and really just use that as a marketing tool. And there are people that truly care about their clients and do planning. And I think everything adapts from a financial plan. How you get charged, that I don't really care about. I mean, if you want to charge a flat fee or you want to charge a percentage AUM, I don't care. As long as you're doing the job for the client.
Well, I always say my brother's in law enforcement as well. And there's bad doctors too. He's dealt with them, right? Just because you have an MD doesn't mean you're a good person.
Yep.
But it does state, same thing with the CFP, does state you went through certain level of credentials and accreditation to at least have on surface the appearance of knowing what you should be talking about. But I agree with you.
Well,
there's bad CFPs and there's bad,
a third of the battle is having the credential. And there's no doubt, as somebody that has a CFP and you have the CFP, that when you take that test, it's not a brain dump test of knowledge. It's how you actually implement the knowledge.
Correct.
Is the way to pass that test. Correct. And so I fully agree that the CFP means something, but I think there are people that get it with the expectation to do it. And then if they actually looked at how they manage clients, they're not using it properly.
I completely agree. The analogy is, if we're going back to that doctor analogy, it's like a knee surgeon trying to do heart surgery. That's a bad doctor, right? That's a bad practitioner in our industry. If I have no expertise on estate planning and I'm trying to go in there and help someone build out their estate plan just because I think I can get their AUM, that's probably not the best interest for the client. That's how we delineate good versus bad advisors. Absolutely.
Let's talk about FinTech.
I love it.
You are on the FinTech advisory board. My buddy Matt Gardner is a big FinTech guy, and there's a lot of people I've interviewed on this show since we started in August that are in that field. I love it and I hate it. And let me explain. I love that there's technology every year that is making us more efficient, smarter, and more capable of finding out information. I don't think it's ever a replacement for the relationship and the ability to ask people questions and get answers that are not just using here, but that understand here. You're on FinTech advisory board. Talk us a little bit about what you guys do and that structure and kind of where you think things are headed.
Yeah, I wrote a paper, I think it was 2017, or an article in Financial Planning magazine, and it was all about robo-advisors. Now that's kind of weighing in terms of the fear around, is robo going to replace the advisor? How do you replace the personal touch? And the gist of the article was that it won't. It's just like autopilot on a plane. Am I going to get on a plane with no pilot at this point? Probably not. And does the pilot fully take control of the plane the whole way? Probably not. There's some integration of technology and the human component, which I think is very interesting. So I agree with you. The robots, the FinTech will not replace the advisor, in my humble opinion. It will augment and enhance the advisor's ability to deliver personalized and specific on-demand advice to that end client. Mm-hmm. And if you think that a FinTech is going to give you all the answer and you just have to regurgitate it, I think you're probably in that bad advisor camp that we're just talking about.
Yeah.
So what does that mean? There's a dearth of technology development in our industry. I look at other, and granted, there's a lot of compliance and, pipings don't connect and all that other fun stuff to understand it. But we're so far behind. If you look at my watch, right? It's a Garmin, and there's so much that data that comes out of it. And I look at FinTech in the same way of saying, hey, it's not going to make me go run, but it's going to help me train and monitor when I do go run. And I think that FinTech can make an advisor's life a lot simpler. One easy case example is Plan, which we use. I think it's great software. It simplifies the ability for me to have to read through a tax return, itemize it, and it does give the advisor some nice little tools in a very simplified and easy to digest, and more importantly, easy to translate into actionable items, information on the fly.
What's it called?
Plan.
Plan. Okay.
Yeah. So that's one, I think, really good example of how does it make my life as an advisor augmented. That's a great example. InvestNet, we mentioned, is a technology where instead of when I started the business almost 20 years ago, you needed 10 people trading, right? To trade 1,000 accounts, you need 10 people trade. Now you can deal with 1 or 2.
Yep.
So I think those are ways where FinTech can continue to improve.
Yep.
And I was on a panel at an institutional conference last week, and the analogy I used was the original Fitbits would just tell you what their heart rate is. Now the Whoop watches and more the evolution of wearable devices, it's more predictive, saying when you should work out, when you should not. And I think FinTech will continue to evolve in that area and not tell you as an advisor what the answer is, but help you make decisions when your client is stressed, or understanding the implementation of when they're stressed, they react in this way. So you as an advisor can provide better guidance and better advice. Because at the end of the day, our job is to provide advice, right? It's not to get a certain rate of return. It's not to provide certain insurance. It's to make sure clients live the life they want to live without the stresses of having to deal with financial uncertainty.
When we were talking, I had Simon on last week and I had Riskalyze on a couple of weeks after. Those are 2 other softwares that are just revolutionizing the business. So I think FinTech is a phenomenal arena, and what we're able to get out of it, it's super interesting. And it's funny you mentioned the robo-advisor. My prior firm, I was on the advisory committee. Basically, they would run the ideas through us that were good, bad, or indifferent, and kind of get our opinions if we were going to yell or not. And one of them was, we're going to introduce robo-advisors for this. And just the way they had brought it out, like that, look, there are a segment of the population that don't need you. And they might not need us as much today, but they will need us in the future. And I was trying to string where they wanted to go and where I thought they should go. And the concept that, you can get managed portfolios done for people that have 5 or 10,000 of investable assets and probably are not going to be able to work with somebody like me or you right off the bat.
Right.
But how do you make sure that you tie them into an advisor where when they do have those personalized questions, that they can still run those by somebody that's qualified and not an 800 number? And I think that's the next step. How do you take that from an easy asset allocation, getting your money working for you, dollar cost averaging and standpoint, to the advice model?
Yeah, that's a tough leap, right? Because it's hard to scale personalization. You go to Vanguard and they got a service where you can call someone, but you're going to get Vanguard's models, right? They're all singing from the same song sheet. Personal Capital has, I believe, a model where you do have access, but it's different pricing. So it's a challenge, right? The industry has this challenge. And I think a lot of investors, you talked about young advisors, but young investors, they've expected free now, free trading, free this, free that. And obviously when you get something for free, you're the product, right?
You're the product.
Robinhood is a great example of that. And even in the case of robos, I don't think if you look at the Wealthfronts and the Betterments, their metrics, their financial metrics internally, I don't know how profitable they were on just the AUM based on those fees. And I think, to your point, you have to go above and beyond, because let's be honest, investment management has been democratized. To get an ETF portfolio in a diversified fashion,
you can Google it now.
You can get it for free anywhere, right?
Yeah.
So it has to make that leap.
Yep.
And I think where it's hopefully going to go, to your point about personalization, the more specialized you can get with client segments, the deeper you can go and scale that, right? Because if I'm an expert in XYZ client and that's all I do, I can spend a fraction of the time that you would having to learn more about that person. So if all you do is stock options and I have to spend 6 hours learning up on it and find the right people, that's not that scalable. Whereas I think the specialization route for that advice is going to be the future of how can you scale in a semi-personal fashion to make sure that I don't think you need full on advisory services, but you need to check in and do the fundamentals, right? You need to understand how insurance works. You need to understand the basics of estate plan. You need to understand the basics of budgeting and financial stewardship for your assets before you get into how do I become the next crypto millionaire.
And maybe hiring those generational advisors to cover those younger generations.
That's exactly what we are doing. And I'm sure you are too.
That's my next step.
Yes.
Yeah, it's the step. I honestly, pre-doing this show, I wasn't thinking along those lines. I was thinking just, that at the end of the day, as people, we're going to grow into what advisors are currently working with, which is a wrong thought because their mindsets are completely different than our mindset is. I'm not aging you.
I'm 40.
You're 40, so you're kind of right where I am at 42. You can see the difference.
It's definitive.
It's definitive, it's big, and it's huge. One other question, private equity. I talked about this with a few of the different RIA owners that I've had on the show as a
strategic investment or as an asset class.
Well, we're talking about private equity and we're talking about venture capital in the financial advisor role. Okay. So merchant, have you heard of merchant before? These companies are coming in and offering these propositions and they sound good and many advisors are buying into it. And the answer I've gotten from some is stay away from it. You know, if it sounds too good to be true, it is, which very might be. But then there's the hat that I'm only 42. And if I was 62, maybe I would be thinking about it a whole lot differently that, hey, I can monetize this and there's an opportunity to do it. You have $1 billion in assets. Once you hit that $1 billion mark, that's when these firms, I guess, start coming and they start knocking on the door and saying, hey, Shane, you know, we should talk. You got advisors. We're going to be able to help with the capital and, you know, what are your thoughts on this segment of the market? Is it these 12 to 18 times multiples that were getting quoted last year? I doubt they'd get them now this year, but those were the kind of quotes that were getting passed around out there. What are your thoughts on this?
I love this space because this is where I spend a lot of my time thinking of if you're building a multi-generational practice, you have to be thinking about it, right? Strategic partners, strategic investments, et cetera. So if you roll it back, this industry was basically a sales industry for the longest time, right? You're either an insurance broker, or you're a stockbroker, right? And then it evolved to financial planners and wealth management firms and RIAs and firms like the Ensemble Practice and Moss Adams started doing consulting, and then Mark DeBergian really became a figurehead in that space for purchasing advisors. And then they got old, right? So you have advisors that were successful that evolved into wealth management firms that built up a practice and a net worth and a valuation of the practice significant enough where it wasn't financially viable for the next generation to buy them out. So they have no other option. And I get that, right? So you want to monetize your practice. Most advisors are focused on new business development and servicing current clients. They're not focused on training next generation. And I think that's where Philip Pallavi's firm done a nice job with their G2 Institute, trying to train that next generation to be a business owner mindset. But there wasn't a lot of them in there, right? So it's a natural, because I think we're a younger industry in general versus doctors or lawyers or whatever it may be, that's the first wave. I would say, I think to your point, valuations are definitely coming down. You know, interest rates are, it's no secret, right? There's an inverse correlation most likely between higher interest rates and lower deal valuations. We've seen it in a lot of different industries, though. We work with dentists and oral surgeons, and you see it in medical professions, the DSOs and the private equity backed shops. It's very attractive, especially our world, because there's recurring revenue and there's a lot of client retention, which you can provide a higher multiple for a DCF model. You know, if I'm spreading it from a private equity standpoint, that valuation model is very attractive for them. I question at the heart that each advisor should ask why or think about their exit earlier. Because if you wait too long and you're in your 60s, it only becomes kind of one option. I think it takes a long time to really build the next generation succession. You have to do it in pieces, because it is a scary proposition to go tell a 35-year-old, go take a $5 million loan to buy me out and I'm gone. So the way we look at it is that's a very interesting space. And I'm never saying no, but at this point we're looking at internal transition, and maybe you don't get those ridiculous valuations. But the way to keep culture from a multi-generational standpoint, you have to look at it internally, which means that you need to provide equity partnership, path to partnership. You need to start thinking about this earlier when it's not a $10 billion RIA and there is really no option. So I think it's an interesting space. I think it will slow down somewhat. You know, some of them are public, the Focus Financials are public. Some of them have, I think, delayed some of their IPOs. I think Dynasty delayed their IPO. The industry is aging. There's not a ton of young new advisors coming in. That's an issue for the industry to address. And I think provide proper training, because your 25-year-old here is probably not going to go out there and say, here's a list of 100 clients that I potentially could have, go call them. And as a senior partner, I can help you close, but figure it out, because that's how I did it. I think that's a lot of the mentality of the older advisor crew. I think it's to their own detriment. We all need to kind of step away and say, how I built my practice is not how the next generation is going to build it. I played college football, right, in early 2000. And if you look at football, right, the 3 yards in the cloud of dust in the 1970s, 60s, 70s of football, Big Ten, that was a way to win games, right? That's the Ohio State and the Penn States. That's not how you currently win games now. And if you don't evolve, it's still the same game of football, right? Same basic rules.
Yeah.
How you play it is different. And I think advisors need to be aware, if they're a coach in that case, or they're looking to succeed, provide succession, they also have to acknowledge that addressing the next generation, not just from a client standpoint, but from a partner standpoint, is really important.
Well, it's, people ask me a lot, Evan, what do you get out of the podcast? And what I'm getting from the podcast is, well, a multitude of things, but primarily as I grow and as I want to grow, it's no longer about finding an advisor to help cover the smaller clients. That BS. It's really got to find multi-generational advisors that come in and step up and take care of clients and build that process and build the book the right way. And you can sunset off in any kind of multiple later, especially if the firm is built right. Yep. The valuation of the firm probably would go up anyway. So why wouldn't you start building that way today? Like, why? What do you?
I think that's where the industry still has a sales mentality. I mean,
I can get out, I can get my 3.5 times now, and I'll
who gets promoted at conferences, right? It's not the person that had a thoughtful internal succession. It's the person who had the most GDC.
Yep.
It's the big numbers.
Chairman's Club. Yeah.
100%. Yeah. So the industry needs to think about how they reward people, or at least how home offices think about rewarding people. Because how you reward is kind of, your activity will follow that, right? How you're compensated is usually how your activity.
Well, it's funny because when you're a younger advisor, you don't use that metric the same. You might use AUM growth as a different metric. Firms don't tend to do that. They reward people that stay around and pay them the most.
Well, yeah. If you get really down the line of cynical, right? If I'm a big broker dealer and I kind of want that practice to transition. Most of the clients will probably stay. It may get split up a couple advisors, younger ones that don't have the same grid payouts. And so, who knows, right? There's a lot of different motivations, but the industry needs to evolve on a lot of different levels if we want to really do good work for our clients.
Shane, I always ask this question at the end of a podcast. You're leaving here, you're on your way back to your folks' house, and you're thinking, there was one thing I really wanted to talk about, or a point I really wanted to get across. What would that be?
Start with why. It's the Simon Sinek thing that's a bit cliche nowadays, but people don't really think about it. I would argue most people say, why did you come in this business? Well, because I want to really help people. And I'm like, go be a nurse, go be a doctor. Like, let's be honest. And if you want to be a business owner, think about how to run your business as a business that happens to be in the industry of financial services. So I think be honest about what your why is. Is it about making the most money possible? Great. There's a lot of ways to figure it out. If it's about figuring out succession and transition, do it. Just don't talk about it and then complain when you're 65 that no one could really take over your practice. So be honest with yourself, think about what your why is, and don't compromise.
Know your why.
Yeah.
Couldn't say it better.
Yeah.
Shane, thanks for coming in.
Thanks for having me. It's been a blast.
If anybody wants to get a hold of you, how do they reach you?
The website's ironbridgewc.com. I'm on LinkedIn, just my name, Shane, Shane. Last name is Morrow, like tomorrow. Yeah, that's... Great. We have a Twitter page, but to be honest with you, I don't really. That's the next phase of our marketing.
The next generation advisor needs to go run that.
They're already taking over, giving me ideas for marketing, and I'm like, we'll deal with it.
Yeah. The problem is getting the marketing of these broker dealers to understand that the marketing of the past has to come with the marketing of the future.
Yeah. 5 articles of 5 things that you can think about for retirement is not really getting much traffic out there.
No. If you have a LinkedIn page and you're sharing your corporate broker dealer stuff, nobody's looking at it. So.
Yeah, exactly. I completely agree.
Again, thanks for joining us. Hope you enjoyed the show. Subscribe if you can and send any feedback you like. Thanks so much.